Hey guys, welcome back to the channel. This is Brad, your host. Today I'm going to talk about how to invest for beginners. I had a friend this morning who asked me, he wants to get into the stock market, he wants to start investing, and he asked me, where do I start? I was thinking, man, that's actually a fairly difficult question to answer. So I'm going to try to answer it in this video. So Buffett once said there's really only two things that you need to learn in order to become a good investor. The first is how to value businesses, and the second is how to understand market psychology, which is kind of the price movements in the stock market, which are made up of individuals, obviously. So let's break down the first one, how to value a business. Now, you don't actually need to know how to come up with a precise value for a business. Like, this business is worth $13.2574 billion. There's no precise value to a business, because essentially what valuing a business is you're estimating what that business is going to earn in the future from now until Judgment Day. And you're going to discount those earnings back to today. And that's going to be what that business is worth today. So there's a lot of estimates that go into valuing a business. It's not an exact science. And it also has a lot to do with the story that you have about what that company is going to do in the future. And there's a professor at NYU, Aswath Damodaran. He does a great job of talking about how valuation is part art and part science. And the art is really the story. What is your story for that business throughout its life? And then you can kind of come up with numbers based on that story. And obviously you're going to be looking at past numbers as well to guide, your estimates for the future. But some of the best investors, they don't rely on any kind of accuracy in their business valuations in terms of what a share of stock should be worth based on what the underlying business is doing, because a share of stock is really just a partial ownership in a business. So the great investors that I know, really what they're looking for is a situation where you can buy a share of stock for much less than what they think the likely value is. So when the price is much lower than their general estimation of the value, okay? And that's called a margin of safety. You want a big margin of safety because the future is uncertain. We don't know what's going to happen with the business. There are all kinds of things that can happen in any industry to throw that industry into a short-term or even fairly long-term tailspin. So, there's a range of possible things that can happen in the future, and those range of outcomes are potentially dramatically going to affect the value of a business. So really what we're looking for is when the price is significantly below what the general estimate of value is. Now, I'll take Monish Pabrai as an example because he's my mentor. He doesn't know it, but I watch all of his YouTube videos. He's written a couple books. I'm really studying him because he's the closest thing that I can find to a young Warren Buffett. And so, you might think, well, why not just follow Warren Buffett now? He's still alive. He's still making investments. The issue with that is when you have a lot of capital, when you have a lot of money to invest, it really limits what companies you can invest in. Because, typically You can't invest more than 10% of what that company is worth, because you start running into some legal complications that make that not very compelling for an investment manager. And so, when you have hundreds of billions of dollars to put to work, I mean, most of the companies in the world are too small for Warren Buffett to be looking at. Now, that's not the case with Mohnish Pabrai, and that's why I really like looking at him and following what he's buying and selling. But anyway, so that's the first one. Being able to not value a business specifically, but understanding that there is a difference between the price of a share of stock and the value of a share of stock. And, looking for opportunities where the price is significantly below the value. And great things happen when you're able to find those opportunities. There's much more upside on those investments as compared to downside. So that's the first one. Let's talk about the second one, understanding market psychology. So the stock market, is really just buy and sell decisions from people like you and me, individual investors. Of course, there are bigger investors, but we're all humans. And it's actually quite shocking how even the professional investors can make bonehead decisions around fear and greed that aren't based on rational thought processes when it comes to investing. Everyone makes mistakes, even the brilliant guys. So market psychology really plays into what I was talking about in terms of that there's a difference between price and value. Now, price tends to fluctuate much more than value. And the reason for that is humans are really driven by fear and greed when it comes to money and the stock market. So there's this peculiar thing where when prices are going up, when stock prices are rising, say Apple, for example, when Apple was down around 150, not that long ago, I want to say it was somewhere around a year ago, nobody wanted to buy it. Everyone was looking at Apple like, this thing, this keeps going down. Like, what a crappy company, what a crappy investment. Who would think of buying this, right? And then as the price starts to go up, people look at it like, oh, this must be good because the price is going up. Other people like this, so it must be a good investment. Now, the reality of that situation is as the price is going up, the investment merit of buying Apple is going down. Especially when it goes up quickly. When it goes up faster, then it makes sense for the actual business value to be going up. And you see this all the time. Tesla, maybe 7, 8 months ago, was trading for $180 per share. Over the course of 6 or 7 months, it went up to, I think it was like $960. Tesla went up more than 5 times in 6 months. Now, it wasn't because the value of Tesla was going up that fast. Sure, they were doing some impressive things in China. They were putting out a lot of cars, more than a lot of people thought they'd be able to. But the value is not going up 5 times in 6 months. So understanding that there's a difference allows you to take advantage when people are fearful and the price is depressed more than it should be, okay? And alternatively, to take advantage by selling when the price is higher than it should be because people are greedy, everyone's piling in, they think, oh, this thing's gonna go to the moon, this can't miss, and so everybody piles in. I remember this happened with Bitcoin maybe 3 years ago or so. I think it was at a couple thousand, and it went up to 20,000 in the span of like a couple months maybe. And you know, you see this mass psychology happening there where, you know, because the price is going up, people think, oh, this thing is a great investment. And that's exactly the wrong cue to decide that something is a good investment. Buffett says, you know, when the price of hamburgers go up, you know, the Buffett household weeps. When the price goes down, they jump for joy, right? Because they're going to be buying hamburgers for the rest of their lives. And they're not looking to the price as if that's what indicates, you know, what the thing is worth, what it's valued at. A hamburger is a hamburger. I mean, not to everyone. Some people like their grass-fed hamburgers, and, you know, there's all these different sustainability measures, right? Free range, whatever it is. But yeah, the price, people get weird in the stock market where they're looking at price as if, you know, when price goes up, it's better. They get excited. When price goes down, it's worse. They get bummed. What the stock market is doing right now, you know, going down, down, down. We're in a recession, if not very close to one. The true investors are looking at that like, wow, everything's going on sale. This is great for my investment portfolio. I have a chance to buy more of the companies that I love at cheaper prices, which, you know, is going to do great things for my portfolio. So that's kind of the understanding market psychology piece. That's only one part of it. There's a lot to really understanding human misjudgments, how humans act irrationally when it comes to investing in stocks. There's whole books about that. One I really like is Poor Charlie's Almanac. It's about Charlie Munger and how, you know, he's really spent so much of his life trying to understand the mistakes that humans make when it comes to money and investing so that he can avoid those things. Because really one of the main reasons Charlie Munger and Warren Buffett have been so successful is by avoiding mistakes, not by doing things that are brilliant. And that's, you know, that comes as a surprise to a lot of people. They look at Charlie and Warren and think, oh, these guys are just brilliant. You know, they're doing things that nobody else can see. But really, they're just, a lot of what they're doing is avoiding things that they don't understand and, you know, swinging big when they find things that they do understand. So that's all I wanted to share, guys. If you're just now getting into investing, really integrate those two things. This idea that what makes a great investment is when the price is significantly below the value of the stock. And you can look videos from Aswath Damodaran. He values companies and does a great job. That's a great place to start for that. And then the other one, understanding market psychology. Understanding the irrational behaviors of humans in the stock market. And understanding that price fluctuates much more wildly than value. And if you understand that, you can take advantage when people are, you know, in a crazy greed state and markets are at bubble price territories, you can sell. And when people are really fearful, like everything is just going to disappear, when the world is, you know, every company is going to go bankrupt and we're going to enter a completely different, you know, state of humanity where there's no more dollar bills, you know, something like that. So if you understand those states, you can learn how to identify them and learn what a prudent investor, what an intelligent investor, the actions that one of those would take during those parts of the market cycle. So anyway, that's all I wanted to share, guys. I hope you found this useful. Click that subscribe button. I'd love a thumbs up or a thumbs down if you thought this video sucked. Either way, just I'd love some engagement from you guys. So that's all I want to share. I'll see you in the next video. Take care.